right now we're in what I refer to as an energy drink economy. If you don't have some substance after an energy drink, you're going to crash. And so we're in that phase now to where we're needing to find some substance.
1, 2, 3, 4.
Hey there. Welcome to the Small Business Black Holes podcast with Alan Pentz, where we help you navigate today's chaos with precision. Your host, Alan Pentz, has 25 years of experience working in business and government, and he knows how the old rules have fallen apart. Each episode, we'll explore how to thrive in this new landscape by mastering the small business black holes while everyone else is still figuring them out. Let's dive in.
Well, welcome back to Small Business Black Holes podcast. We have two from Owner Institute, by the way. If you're on YouTube, hit that like button because I need to be famous. And we've got two, I don't know, they're pretty good, I guess. That's all we could get at the last minute. But from Simple Numbers, Brandon Gray and Mike Maxson, they're the two of the principals in Greg Crabtree's legendary Simple Numbers organization, and they're going to be talking small business today. So welcome, guys. Good to have you.
Thanks for having us.
Yeah, looking forward to it.
So just as the disclosure, I've been a client of Simple Numbers since 2016, I think, something like that.
It seems longer. Maybe it's just you.
Life without Alan is just a blur.
I talked to one of your clients yesterday who's been there since 2015, which is pretty insane. Because I think Greg when did he write the book? 2012 or something like that?
Came out in 2010, I believe.
Okay, so it's pretty early. All right, gotcha. Cool. Well, guys, so what I wanted to hit today is you see businesses, all different types, all across the country, across the world now, right? All different sizes, every industry you can name, right? And you're looking in the guts of them. And one of the things I was talking to Greg about recently is just how like most business coaches don't even deal with finances really. They don't really even look at them. So like how do they even know what's going on in the business? So you guys are in the nerve center of every business. So tell us, like, what does it look like when most companies come to you for the first time?
Yeah, so I'd say there's a variety of conditions, you might say. I somewhat equate it to almost like a doctor having a new patient. And, you got to kind of give an overall exam to determine the health of where that patient is at to kind of go along with the particular issue that they came to see it, And so there's a handful of different conditions that we find folks in. And so I'll start with kind of the worst and then make our way up to the best. You have every now and then you have one come through and they're what I consider life support. So they really don't have much in terms of capital. They're maybe living off the line of credit. And they're fastly approaching the ceiling that's available on that line of credit. They've many times had a history of losses inside the business. They're trying and working on what I got to do to change that picture. Their profitability picture is usually not the best at the current time. And so you look at it and kind of go, man, we've got to do some emergency surgery here pretty quickly. If the patient's going to survive, we've got to get the scalpel out. And so, that's one into where we're going to, as we evaluate it, determine what are going to be the quickest and most effective changes that they can make inside their business. And 9 times out of 10, we're going to look at things like their management, administrative labor spend. And that many times is one that's just bloated. It's too heavy for the size business they are right now. In some cases, they're overspending on things like marketing. It's not being effective in producing a return. Occasionally, but we don't see it as often, their direct labor component's just out of whack. They just got too many people sitting around not doing things that they should be doing if they were running at full capacity. And so you got to kind of have an exercise to right size it very quickly and get profitable with what you have.
Yeah, just to be clear on that, direct means the labor is serving the client or customer or the delivering the product or service. So directly involved in that. And management and admin is all the back office selling management stuff, right? So a lot of times what'll happen is you might grow and then grow your revenue, you grow your back office staff. And then when you shrink, you're not making the adjustments in that back office. And direct tends to go up and down because it's more, you can see it more clearly, right? Like that person's sitting around, they don't have anything to do. So, maybe it's time for them to go versus in the back office, there's always stuff to do, right? So,
Right. Yeah. It doesn't jump out as quickly. And, in some cases they were growing at a certain rate, and then that growth just starts to stall. And they had basically looked at that and said, I need to add labor ahead of my growth. And the growth never showed up. So see that quite often. So that's kind of the first condition. The second one that you see folks come, and I would say that's not it happens, but it's not like every client we deal with is in that situation. The second, and I would say this is probably the most common, to where they're if you gave the physician analogy, they're not in intensive care or emergency surgery, but they got some issues. They're going to need to hang around in the hospital for a little while till we can get them on the right path. And so those companies typically look like mediocre profitability or sporadic profitability, meaning, they might do really well 1 year for 6 months and then it just falls off. Kind of up and down. There's not a strong rhythm or a pace to profitability. They have some capital, but they're usually constrained by what we talk about in Simple Numbers 2.0, their trade capital signature, which is basically the amount of cash that you need to fund your organization during a time of growth. And so, they kind of can maintain status quo and still make payroll to be okay, but the minute they start trying to hit the growth button, they don't have the capital to fund that. And a lot of times they're not even aware of that.
That's and then Brandon, that is real quick, man. That is the one where it is the most common because you can tell they have no idea what the planned outcome looks like. And so they're just, and usually when I talk to them, that's what you find out in the discovery phase of going, hey, I think I'm doing good. I could be doing bad. But I don't know what 3 months looks like. I don't know what 6 months looks like. I think I need to hire someone, or I think I need to invest in this piece of machinery or whatever, but I have no idea what my cash flow looks like. And so that it's getting to that, what Brandon, I think is really getting at is what does that planned outcome look like 3, 6, 9, 12 months from now? And what the impact of those levers that I pull along the way. Those are the ones, and that's the most common we get that just can't see that far out. And that's what we try to show them.
So is it that they don't understand their payment terms? Like, is that part of it, or is it like they just can't project out the revenue growth?
Well, they typically understand the payment side, but they don't have a way of getting their hands around, as I grow my revenue and potentially change my profit signature. I mean, I might grow revenue, then I realize, oh, I'm a key position away now because things are moving so quickly, what that's going to do to profitability. And then how that's going to translate, because you kind of think about it, my revenue's growing, my receivables are going up, my payables may or may not be going up, my inventory, if you have it's going up, but I don't have as much profit as I once had. And so now trying to make the cash flow component of that work gets really messy.
Right. So like as you're growing, you might have the same payment terms, but you do hit these, I guess, places where you're going to have to add maybe more direct labor that isn't completely amortized yet because you're growing. So you hit like you guys, all your consultants are max, so you got to take on a new consultant. Takes X amount of time to train them and get them up to speed. So direct labor gets out of whack, or you have to make this back office hire that can hurt profitability. And so if you were managing sort of to your bank account, kind of by instinct, you're not going to really be accounting for these additional costs and know how long revenue is going to need to take to catch up with that expense.
Exactly.
Is that sort of yeah. Okay.
Great. Greg said it best where he just said that, in that small business phase there is, cash and profit are on two different tracks, and really you're searching for how to get them to the same station and then align together. And I think that's where, and, he has those phrases, man, but that was a good one that made sense, right?
So Brandon, what about you?
Yeah, well, what I was going to add is if you have an inventory component to your business, now you've got an extra layer of complexity when it comes to the cash flow side. And so, you're trying to forecast out what are my receivables going to grow by? What is my inventory going to grow by? What types of terms am I going to get from my AP and if I'm using credit cards? and then correlating that back to the amount of profitability that I'm creating to then determine what kind of cash am I going to have. And that's you get a lot of moving pieces during that part. And so a lot of times that becomes very difficult for them. They no longer can just use their gut.
So it's like you got a bobcat running after a jackrabbit, and they got to meet up at some point. Is that
Skunk up a tree, yeah, with a skunk in the woodpile next to it.
That's right. I give Greg a lot of grief for his homespun Southern metaphors and analogies.
The third group that we see are the ones who their business looks really good. They're fully capitalized. They're hitting profit targets. You kind of look at it and go, man, this thing looks good. I don't know what value am I going to be able to add? But what they really need is they need education on where should they be at? What levers should they be working on inside their business? They need coaching of kind of, hey, it's all good today, but if I want to grow, what's this going to look like? They need accountability. Many times in those organizations, the owner has been able to drive it to a certain point, but now they've got this executive or mid-management team that has more and more responsibility, and they need to get up to speed on understanding the financial components of their business. And so, you're bringing them into the picture and into the calls and kind of coaching them and helping them as well. And those are a lot of fun to work with because, you've got a really solid foundation. And they have the capital to be able to reinvest back in their business. And we can track those returns and what have you there.
So I would also say that there probably a danger is if you have a lot of capital lying around, your tendency to invest in things that are nice to haves but aren't going to really drive return probably goes up.
It can happen. Like you said, it's one of those things to where you don't want to be, like everyone agrees, you don't want to be capital constrained. But rarely do folks look at it and go, I might have too much capital. Because like I said, that does tend to slower decision-making in some cases if the business starts to decline a little bit and the chasing of the shiny object.
That's right. And that's why, like in public companies, you see activists come in and be like, hey, distribute your cash, right? You don't have a good use for it unless you can show me a case, like start, share buybacks or dividends or whatever, right? So that's a good discussion to have, I guess, right? That's the happy one.
So without a doubt, yeah.
Yeah, excellent. And then, so you guys see these kind of three business types come in, and how do you often see that people progress up the ladder to getting to, I go from type 1 to type 2 to type 3? And like, how long does that take people to do? And what are like the things that, because I would say it's always the owner, right, who's preventing that progress. They either hired it, did it, or let it persist, right? So what do you see as those blocks to them moving through the stages to get to that last stage?
Well, I think it starts for me, what I see is, I think it touches on Brandon's point. He said it when he was talking about the companies that are doing really well. But what I see is when the companies begin to add that next level of management and begins to pull further and further away from the owner. And so now you're beginning to, the owner is going to take a more specific type role. You're going to bring other people in, and now you're going to begin to, I guess, act like a real business. And now it's that accepting of, hey, Brandon is the ops guy and he's going to run this now, or I hire, just like you, Alan, a president of the company, or what have you, where you're going to begin to give those reins away, and they're going to do that. So you see them progress, but that is going to be a barrier that they have to overcome, because you make a bad hire in there. You make, you're going to add people, maybe at a faster rate. You're going to promote people, and that can be a block because you might have some misses in there. Me and Brandon know all about that.
You will definitely have misses. You will. I don't think might is the word. I think you will have misses.
Yes. Yeah. There you go.
Any perspective on that, Brandon?
Now, I would say in the ideal world, we all like to look at that, at least if you were to graph it out that it's this nice linear movement, right? You kind of go from being on life support to getting out of that, being in a regular room, and then you're released and everything's great. But rarely is that the case. As the market changes, as your skill set as the entrepreneur changes, as your team grows, many times it's kind of like, all right, I get better, and then I take a little bit of a step back, because like Mike mentioned, I miss on a hire, or I lose a large contract, or the market shifts on me, and so then I have to redesign kind of what my game plan is, and kind of go into a different mode, and then I start to improve it a little bit more, and something similar types begins to happen. Maybe it's a new competitor or what have you. So you're kind of in this little bit of this back and forth, always working on it as you move up the chain. Years and years ago, when I had hair on my head and none on my face, and I was working on my master's, I did a study of entrepreneurs, and it was based to a large degree on a lot of our client base at the time. And what I found was the number one obstacle to growth for a company to be successful versus those that just kind of hung around was dependent upon the owner's ability to effectively delegate. And I don't think that's any earth-shattering revelation. But, as you look at them growing and trying to move, the owner has to, at certain stages, make sure they have their hands around firmly what's going on, and they're really kind of the key cog in the wheel. But as you get past really $2 million, that becomes more difficult. You've got to have someone, most likely, and what we recommend is on the operational side, because we're advocates that the entrepreneur needs to stay in sales as long as possible. Okay. And so if they're growing in that journey, relatively small, they're growing in the journey, and they can't get that operational component in place. They just spin the wheels. And then as they get above 5 million, even though the owner would still be responsible for sales, they can't do all the sales on their own. So then they miss on that salesperson. Well, $200,000 later, they realize they missed. And, that's another kind of thing that slows people down in this trajectory is when there's any doubt, there is no doubt. It's kind of the saying. They keep buying hope. And so it's like, look, they're not going to perform. This is not going to work. You need to move on. We need to find somebody else. And so that during that phase, it pushes them back down, obviously. And so, as they continue to grow, their skill sets have to adapt and change. And they have to really have a great ability to delegate, put people, allow people to operate in their highest and best use, and hold those folks accountable.
Yeah, I see. I mean, it's almost like it's a journey where people get stuck along the way. I mean, now you see where I get all this stuff from. But yeah, I mean, I've always seen it as like there's a guy, Brent Beshore, who I like a lot too, has a company, it does a lot of private equity. And he calls it a ceiling of brute force, where like an owner, usually for a bootstrap kind of company, the owner's good at sales, right? Because that's what got them into it, right? You had to sell some stuff. And if you get to a couple of 3 million, you've obviously sold whatever it is, a bunch, right? And, they could probably drive it up above 5 if they're amazing salespeople, right? Because they can just get customer net. I would wager that without a lot of other stuff going on, they now have complete chaos in their company, right?
Oh yeah, it's a zoo.
But but they eventually they're going to hit that ceiling of brute force before they get to 10 million at least. I would say, well before that usually. And it's like you said, it's about changing your mindset. And then I would also wager that when you hire that 150K salesperson, 200K, when you're 6 million and you're managing by instinct and bank account, it's probably easier to not notice that it's not working for longer than it was when you were 2 million, right? You got more cash flow going through that you're not. And if you're not on top of your numbers measuring these investments, you can let it go on.
Oh yeah, that's what I mean. Further away from the owner. That's one of the barriers. And once that owner accepts that, like, hey, I can put the things in place to monitor that, and have an accountability, like Brandon mentioned, with it, that's when they start, getting it dialed in. But that barrier right there is that man, that's a way. I remember, here's a funny Greg Crabtree story. when we started hiring people without Greg knowing, like when that started happening, he would be out of town and he'd come walking in, he'd see him walking by and he'd stop and he'd like look down the hall and he'd like weirdly check the person out. He'd walk up and down, look at him again. He'd walk into my office and he'd go, who's that person? I'm like, oh, that's a tax person we hired. Oh, what's her name? Like, here we go. You can walk down there and introduce him. But like it was at first it was like oh wow, like I got people making hiring decisions here and doing that. And it took time for him to realize like, oh, I got to get used to that happening now. And when I changed all our proposals and our pricing and stuff, he goes, listen, just do it. Just I don't want to know. I don't want to hear about it. Yeah, tell me because he's such a good guy. He just do it for free, by the way. But again, it was getting further away, and he had to break that barrier, but then put people in charge. Unfortunately for him, it was me and Brandon to execute on that stuff.
Yeah, well, it's all, you have to go from managing by instincts to managing through some kind of data, right? And because you can't just turn stuff over. So let's talk about that a little. The idea. We talk about owner independence and owner institute, but the first time I told you about it, Brandon, you were like, well, don't be telling me some $2 million business guy is going to hand the keys and go play golf to a general manager and take off, right? That was the first thing you said. So talk a little bit about what you've seen over the years with people trying to achieve independence like that.
Well, it can happen. Not saying it can't, because it can happen. What the biggest mistake we see is that folks try to make it happen way too early in the process. And so, there's a lot of books out there around systems and processes, and you got, like the E-Myth, and, I'm gonna put a process in for everybody and everything, which is great. And then I can just step away and this thing's gonna run on autopilot and everything's gonna be great. And it's like, no, that rarely works with businesses that are less than $5 million in revenue. Just entirely, like I said, no one's gonna sell the company the way the entrepreneur sells it. And so they need to make sure they're staying in the sales role. Secondly, you got to kind of look at the ability of your team, and most likely as you've been growing, you've been adding talent that is at the level that your company is at. So Alan, I know you experienced this. And then you get to these points to where, and I'm not saying that these are bad people or they're not doing a great job.
And it was the right decision at the time, right? So that's all you can do.
Yeah. You just get to the point. If your company is, doubling in size every year, growing by 20, 30, 40%, that's faster than any one person's going to be able to adapt and grow. And so it gets to these points to where it's like, I've got to change the level of talent. I've got to upgrade the level of talent to keep this rolling. And so once again, that takes quite a bit of involvement from the owner. They've got to look at it and see what's going on. And I would also say that no one cares about the company the way the owner cares about the company. And so many times, as I've seen owners try to become less involved inside their company too early, it turns into a couple of things. So one is what I call seagull management, which is not good for your team. And that's basically where the seagull flies in, craps on everybody's head, then turns around and flies back out.
These Bama boys and their animal references, man.
I know, they
Got me
love
all
it.
weird.
They love
Yeah.
it.
So you're not attuned to what, if you're trying to step out too early, you're not attuned to what's going on inside the business. You don't know what's happening. All you know is you come in one day, you look at the bank account balance, you freak out, you yell at everybody, and then you turn around and leave, and your team's going, what's going on here? Right? And so once again, you don't maybe have the right components in place to be able to get to that next level from that standpoint. The other thing that you kind of run into is if you step out too early, is that it gets off course to the point where you can't get it back on course. And because there's operational issues, there's team issues, there's sales issues. And so, it takes somebody with enough forethought, thoughts, guidance, and care to kind of keep everything rolling. Now, as you get closer to 10 million, okay, a lot of times you can start to move out a little bit, but you got to be very strategic about that.
Yeah, and I always say, so when I talk about independence, my real definition is that it's degrees of independence, right? So when you're smaller, maybe you can get out of doing crappy work you don't like, right? By hiring admin and stuff. But you need to know I'm a $2 million company. I still got to be the salesperson, right? But then when you get over 5, it's like, hey, maybe I'm just the closer and like the big client person, and other people can take the other part. So you're getting degrees of independence and freedom as you go. But you're 100% right. Like there probably is somebody that could sell for your company at 2 million, but they make 2 million and they work at Oracle, right? They're not working for you, right? So and then I think the other danger you really run into is, even if you got lucky, even at like say 5 million, and found someone who can run your company, they become a single point of failure most likely. And if they walk away, they got you over a barrel. So it's really when you get bigger, you can afford to pay a team that's got redundancy.
And the economics of it as well. So if you look at what kind of household income that you need, not even saying building wealth, okay? And you step out of the CEO role, I've got to bring someone in from the outside market to be that CEO. I got to pay a little market wage. Now, after I'm paying that market wage to that person, what is left in profitability after taxes that I then, if I took 100% of that, which I would not recommend because I can't reinvest in my business, can I even sustain the household? And so you've got to get to a certain size to where that just becomes possible.
And that's also why, so something you guys hammer on is you got to look at what your actual wage is and stop paying yourself out of distributions, right? Because you don't know the actual economic truth of your business if you're lying to yourself and paying yourself salary out of distributions. And that, the IRS doesn't have anybody else to collect now, so we can talk about it openly. But Mike, any additional perspectives on that, like on the owner and the plan?
Yeah, just sub 5 million. There's not enough CEOing to do. And, I go over the value builders with all my clients of things that build a valuable company that one day, if you want to exit or hand it down, what needs to be there. And you really begin to find that independence as your team gets put into place. And it benefits the owner to continue to grow their company and begin to hire that next labor or that next layer of management that allows them to then have that, either have independence through, hey, I went to one role. And now I just sell or close or what have you, and the team runs it. Or you get to big enough to where, hey, I can hire a president of the company. They run it, and I can take a distribution or something like that every once in a while, or just be a integrator, or some of these things that they do, or just a strategy level type CEO. But it's sub 5 million, you're in it, and you're in it hardcore until you build that out. So once that's built out, then you actually achieve the full independence and they can run it. That's why Greg Crabtree golfs all the time and doesn't do anything.
That's right. He had to get over 5 million, then he could golf all the time.
No. We just keep him on the road now, so you will constantly see him speaking somewhere and doing that. But I mean, he knows that back at the office we have people there that are working and doing things, and that way his highest and best use is speaking, presenting. He does high level client work too, but that's how it is he can do that. His level of independence is, hey, you want to fly here and speak or present there? He has the freedom to do that now.
Yeah. And I think even, as you get bigger, like having that owner independence actually increases the value of the company, right? So theoretically, if you could do it at 2 million, it would do that too, but it's almost impossible to do. So
someone would love to buy you up and then kick you out. And that way they take over. You just go to the house with your money and the team and everything's in place and they just do it.
Right. Exactly. So I do think at some point owner independence becomes a value driver, right, for the company,
Oh yeah, definitely.
100%.
So let's talk a little bit about, I know we talked a little bit about the 100 company model that Greg maintains and you guys maintain. And so that's 100 companies of different sizes and all different industries across the country. And it's sort of a little bit of a economic barometer, what's happening with small business. And we're trying to get Greg in with the Atlanta Fed. Maybe we can have a simple numbers now GDP number or something like that, track for the country. But talk a little bit about what you guys are seeing out there right now. I mean, obviously a lot of stuff in the headlines with uncertainty and tariffs and blah, 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 blah. And we're doing this end of March, so just people know they can date stamp it.
Yeah, I was about to say we got to date this because next week it might be might be totally different.
So are there any themes you guys are seeing right now?
So I've been telling a lot of folks that right now we're in what I refer to as an energy drink economy. So, if you follow what has happened in the past 18 months or so, we come through 2024 into 2023, rates are continuing to go up. A lot of commercial activity is really slowed to a halt. Developers aren't developing. Construction's really slow. Home sales are terrible. People aren't buying assets because the financing cost is high. And everyone's kind of hoping that rates are about to come back down. Well, guess what? Didn't happen. And as we got to about September, October of last year, people kind of gave up hope. And they went, you know what? Pencil it in at 8% and let's roll because we cannot make money sitting on the sidelines. And so you started to see projects that were on hold get moving. You started to see spend increase again, reinvestment back. We had the whole election thing in November. And I would say I've been doing this 21 years. For the first time in 21 years, I actually saw people truly slow down to wait and see what's going to happen with the election. Prior to then, it was a convenient excuse. I'm going to wait for the election, which just meant I didn't want to tell you no. And so, but this time they really did. They slowed down to wait to see what was going to happen, right, wrong, or indifferent. And so we got that out of the way. And so we got this energy drink happen in Q4 at the end of last year, where it's like, all right, there's movement finally. Well, if you don't have some substance after an energy drink, you're going to crash. And so we're in that phase now to where we're needing to find some substance. And there's some signs that it could be there, and there's some signs that it's not going to come. So let's talk a little bit about both of those. So 100 company model, we have seen a little bit of momentum in profitability as we turned over the year, got into January and February. It started to move up. One of the reasons why, back to what we talked about earlier, people have finally started to right-size those admin management teams a little bit. So they kind of gave up hope and we made the moves. And so we've seen that. Anecdotally speaking, as we get on calls, we always ask clients about the pipeline and what they've got upcoming and where things moving to. Generally speaking, it's been positive. Now, I would say anything related to discretionary consumer spending is still really difficult unless you're catering to the very high end of the marketplace. So most everyone probably read the Wall Street Journal article around something like 50% of discretionary spending is done by 10%, the top 10% of taxpayers. If you're, as we say, if you're selling Rolexes, business is good. Or if you're selling Casios, it's probably okay. But you don't get to try to sell a used Rolex in this marketplace because the discretionary spending is just not there to support that. And so those are continuing to be challenged. Real estate, in a lot of cases, is still a little challenged because of the interest rate environment. And so you're seeing a little bit of progress. And then you've got if that continues, we're fine. That's the substance we need. But then you've got kind of the storm clouds that are out there. And so you've got tariffs that headline every day. Depends upon what day it is as to what that headline is going to say. Which is not good for the marketplace. The market needs to know what the rules are so that it can adapt and roll with them. And when the rules keep changing, everyone just kind of goes, let me just stop. And so depending upon what happens there, and I'm hearing a variety of responses to those potential tariffs, everything from the bigs, as I call them. What I'm hearing with them is they're just telling supplier, look, guys, you got to figure out a way to make it work. We're not paying anymore. And if you can't, then we're just going to move to someone else. So they're playing hardball, which they can. The smaller folks are, I'm seeing to where their suppliers they're taking a little bit of haircuts, but they can't really take all of it. And the business that's importing can't take all of the haircut. So there is going to be some pushing of price as part of that. That's going to happen in some industries and with some certain businesses and products as far as that part goes. The other one's immigration. And so if you've heard us talk about birth rates and the population, and I'm sure Alan's talked about this before, we just don't have enough people. And so if we have less people, and there are people who are productive that work in certain areas that we don't have anybody to fill those positions and jobs in. And so do we see a stall because of that potentially? Does labor get more expensive? So, and then I would add third with interest rates, because right now, as of the end of March, there's actually a lot of projections saying rates are likely to come down by June, which on the surface, I think everybody goes, okay, great. Well, does that also then potentially stall some things that are about to get started because they think rates are going to come down even more? So then we're back to where we were in 23, 24. So I tell you, it's an interesting time. It's a time that you have to be very, very nimble. You have to stay very much on top of your most leading indicators. And one that I really like is days to close. We need to have our hands around that and where that's going. And you need to keep labor as flexible as possible, because you could be wide open one month and the next month be really slow.
Are you seeing a still wage pressure, or is that's kind of moderated? I feel like a bit.
Yeah. So we talked about that consumer spending being low. A lot of that is because you have seen through the end of 23 and most all of 24, wage inflation was around 3 to 5%. And that was the most common number that I was hearing as people were looking to increase wages. Well, our belief is true inflation is probably 6 to 8%. Well, there's a gap. And so that's one big reason why consumer spending has been as slow as it has been, is it's just not enough to offset inflation. As businesses start to get back rolling, and let me back up. One reason why it's only been 3 to 5% is because there hasn't been enough profitability in businesses to change that metric of any substance. It's kind of like, we'd love to give you a raise, but guess what? We don't have any money. So as business activity improves, profitability improves, I do believe you're going to start to see wage inflation go up. And we're seeing a few of those signs with some of our clients who are growing their teams or who are replacing labor as they go into the marketplace. It's starting to get a little bit more expensive. And so as that occurs and businesses are a little more profitable, we'll start to pay bonuses again. We'll start to give a little bit better in terms of raises. I think you'll see the consumer spending start to pick up a little.
Yeah, I think the story, I would say I saw it in my business, right? 21 into 22, you had this massive increase. It was a lot of direct labor, right? It was getting really expensive to hire. And you were just going out in the market and paying through the nose. Then like end of 22 into 23, you kind of got like the management labor caught up to that. So that went up and internal positions got expensive. And then I feel like in 24, people were like, oh, this isn't going to work. Right. So they started, shaving that down. I mean, it wasn't like massive layoffs, but I think it was like, hey, we're not going to hire that next position, or the person who's not performing that we hired at this huge salary, we're going to get rid of, So like you probably saw the market just kind of calm down in 24. And now it's like question mark for 25, what's going to happen, right?
Well, one thing we haven't mentioned is you still have the tale of two. What I see in the 100 company model is the companies that are continuing to grow, and Brandon touched on this, is it's still in those industries that can get the price increases and I'm not saying what was happening, not at that level, but they can still get some percentage year over year to continue to move up the needle and pay some of that labor, but they have normalized the labor spend. So on our direct labor efficiency, you see it improving because the labor is in line now. But those people aren't getting paid any less. No one's working for cheaper. It's just that they've normalized it, and now they're still able to get price increases and move it along with everything within the model. But then you have the other group, which is several industries, people that aren't in the necessities, or like Brandon mentioned, discretionary spends, where, listen, their price increase is very difficult. They might have maxed out, can't get them anymore. So you see them cutting and trying to normalize back down to, hey, we're not getting any growth from price increases. Days to close are taking longer. Things like that are pushing out. So they're trying to get it back in line. So that's a huge part of the economy right now. The people that can still move the needle at the top through organic growth and price increases. And then you got the other side that's just trying to right now just normalize everything of going, hey, we just can't get it right now until the consumer spending comes back. That'll allow us to reinvest.
And days to close is what?
So from the time you have and for each company to be a little bit different, but if you have like at least a proposal until it is signed, because what's happening in a lot of cases is we're interested. Yeah, sounds great. And your sales team comes back like, man, I got a verbal. It's all great, and you thought it was going to start in June, and it doesn't start until October. And so people are carrying labor from June to October, hoping and thinking this project's going to start. And so I'm needing to get a read of how quickly people are willing to move so that I then can adjust my team accordingly.
Gotcha. And are you seeing, like, I would wager that, high immigrant labor industries, lawn care, construction, maybe restaurants, are you guys starting to see like lack of labor there yet? Or is that would be kind of, to me, like the canary in the coal mine?
What we've heard has been very spotty, kind of, and it's almost based upon headlines too. If there's a lot of news about it, I'll give you an example. So a client of ours that's building a new facility, his construction project has slowed. And the reason why was that folks weren't showing up. They were nervous and scared. So I wouldn't say that we have seen it across the board. It's huge just yet, but it's been kind of spotty in some places. And I think that's going to continue to some degree based upon, what's actually going to take place there versus the headlines.
Yeah, because I would feel like, especially say like residential services, the capacity to absorb price increases is going down, right? So, like you were able to charge more for lawn care for a couple of years there, but I don't think you'd be able to push it up another 10, 25% or whatever it is. People are just going to stop doing it, right?
Yeah, it's not a necessity such as, hey, the sink is clogged. I gotta fix that. Okay, well, those are the folks who can pass on some price increases because you don't have any choice.
Right. If you're a 16-year-old kid in your neighborhood and now's your time to strike, you can underprice the lawn care services, right?
Kids do that nowadays?
No, they don't. That's the thing. They're all at their travel team practice. They can't do that, right?
If only it was 1994 again.
I know.
I could make a ton of money.
That's right. Well, you could. Well, guys, this has been great.
Yeah, thanks. It's been fun.
And so if people want to reach out, the website is the best way, or how do you guys suggest?
Yeah, the website, simplenumberscri.com. Everyone usually reaches out to me. I'm like, if you're just listening to this, but we're everywhere. If you put Simple Numbers in LinkedIn, all that fun places, but Simple Numbers CRI, our email's there. You can hit us up. I think I have it on LinkedIn too, so you can reach out there.
Awesome. I highly recommend it. So 10 years of working with these guys, or 9, I guess, should probably be evidence of the efficacy of the service. So it will be 10 years soon. So good. All right, guys. Well, thanks so much.
Thank you. Appreciate it.
Thanks, Alan. Enjoyed it.
You've been listening to the Small Business Black Holes podcast with Alan Pentz. For more insights on mastering the new game, follow @apentz, that's APENTZ on X, and make sure to subscribe to the podcast so you don't miss a single episode. Thanks for tuning in, and remember, in today's world, you don't follow the rules, you write them.